Um, well, good morning, everyone. My name is Peggy Evleth. I'm one of the members of the board of the Rocky Mountain NetSuite user group. I am a manager with RSM in our NetSuite practice. My area of expertise is foreign currency consolidations, global localizations, basically anything global. So that is kind of my claim to fame. I've been with RSM for about 13 years now. And one of the things that I do internally for RSM, in addition to NetSuite implementations, is create training materials internally for us to improve our global skills. So this is a presentation that I've done for RSM before. I'm now doing it for the Rocky Mountain NetSuite user group because eliminations are something that there have been a few changes over the years in the functionality, and it's important to have best practice if you want to make sure that you can run the eliminations at the end of the month and you won't get strange and unusual entries on your balance sheet. So, okay. So topic-wise, course introduction, I'm going to show you the setups because one of the things that's important about the setups is knowing what should be set up so that if something isn't working, you can go back and look and see that your setups are not correct. I'm going to talk about elimination companies. I'm going to talk some about intercompany transactions, although not in total depth. There's a line transaction feature now that is new in NetSuite that is probably worth touching on at some point, but it's not in the scope of this particular class. I'm going to talk about the actual elimination entries. We're going to talk about considerations for eliminations, and then there will be a Q&A. Although this is booked for 2 hours, I'm not expecting the presentation to last more than about an hour. So if you have questions, please put them in the chat. We have people from the board who are monitoring the chat. I can't monitor the chat and do the presentation at the same time because I tend to lose focus and will focus on the chat and squirrel. So I'm going to focus purely on discussing content, and please, Rocky Mountain NetSuite board members, if you see a question, please flag me, basically, pop up and say, hey, we have a question, and I'll answer them as we go along, or we'll do some Q&A at the end if there are other questions that have kind of come up that you didn't think of during the presentation, but all of a sudden, as everything kind of starts coalescing at the end, you have a question. So there will be time for that as well. So at the end of this, you'll be able to set up a NetSuite instance with appropriate elimination companies, correctly set up intercompany accounts in order to eliminate intercompany transactions at month end, and explain why CTA entries occur and how foreign currencies affect the entry. So now we're getting into the weeds, but the CTA-E entry is a very important entry, and I'll explain why in a little bit. So when you set up NetSuite to eliminate.
Peggy, I'm sorry, just real quick. Before you jump in, can you just discuss how the CPE will work for this meeting?
Oh, I'm sorry. Yeah, you told me to do that.
Thank you.
I forgot. Okay, the way CPE works is there are 4 polling questions. You need to answer 3 out of 4, and you need to stay connected for the length of the presentation. Minimum of 50 minutes, but usually there's a CPE question towards the end. So you want to make sure that you stay connected and answer the polling questions as they come up. It takes about 6 to 8 weeks to process the paperwork for this stuff. RSM does
Can
Peggy,
anyone hear
lost,
Peggy? Yeah,
no,
okay.
Peggy, we lost your audio. If you can hear me, Peggy, we lost your audio. Peggy, if you can hear me, we've lost your audio. Sorry, folks, hang on just a moment here.
Yeah, I just texted her too.
Okay. Whoops.
Okay, so our internet must have dropped.
Yep.
Well, I could
All right.
do some filler for Corey. I work closely with Peggy with a lot of these questions, and so I could give some more context, I guess, around why do we even eliminate. I think that's an important thing to understand as well. Or I could just keep
Sure.
quiet until she gets back.
Yeah, why not, Matt? Let's go for it.
Okay, sure. So the intention or the purpose for eliminations is that, this intercompany transactions, so the accounting principle, it's like moving funds from your left pocket to your right pocket, right? So doesn't matter like if you sell services or you give loans, outside stakeholders, when they're viewing your financials, they don't want to see your financials inflated due to transactions that are amongst related entities, right? Because, hey, this cost me $1, I sell it for $1 million to this other entity I own, right? Hey, that looks great, I'm super profitable, invest in my sub. This other company obviously is going to be terribly performance wise. So eliminations is meant to eliminate all the noise on financial statements from transactions between related entities. So, and in order to do that, right, so the individual subsidiaries ledgers are not impacted, they're not changed, right? So if I had that $1 million in revenue, that when I'm viewing that entity's income statement, I'll still see it, right? And the other one will have the expense. But at a consolidated level, because elimination subs roll up to that top level parent, the entries that are booked to eliminate that $1 million in revenue and or $1 million in AR booked to these elimination subsidiaries. So that's the only activity they have, but it's meant for consolidated reporting to zero out, right, and to remove them. But if you were to break out, a balance sheet or income statement by sub, right, you still see all of those balances in these intercompany accounts, but then the eliminations where the reversal sits, and then at the total, right, that's how you'll see them removed. So that's the concept, that's the principle of why things need to be eliminated, and how NetSuite kind of facilitates it. And also, there's a nuance to it. I mean, if an entity is owned and they're external to their NetSuite environment, that can complicate things a little bit. Ideally, they're still created as a sub, even if they're not transacting. But that's another kind of layer of complexity. But this is meant for entities that are within a one world environment that are transacting amongst themselves. The elimination process kind of removes their activity.
And Matt, when you say entities, it could just be a bunch of subsidiaries. I mean, that's basically what you mean by entity,
Correct.
right? Not a different company necessarily.
Right. Yes.
Okay.
Subsidiaries. Right.
Okay. Thank you.
Yeah. All right. And another important thing to note with eliminations. Now I don't want to step on her what she's going to cover here, but for the sake of everyone's here to learn about it, I have also been working with her on creating a comprehensive accounting guide. And eliminations is one section of this. So I will share my screen here.
Just real quick, Peggy, are you back online? I see you're logged in here. Are you able to have audio? Okay.
Hopefully she Peggy, if you hear and just cut me off as soon as you come on, and I'll stop talking.
Okay, I think I got it
Okay.
unmuted now.
All right, go ahead, Peggy.
All right, thank you, Matt, for filling in. My internet hiccuped, which is odd because I am actually in an office. So it's not like I'm trying to work from home, but I appreciate your filling in that background. I kind of went charging in, assuming that, assuming everybody knew what eliminations were. And I really appreciate your stepping in and explaining the finer details of eliminations and why they're important. So I absolutely appreciate that. So anyway, when you're setting it up, you need to make sure to go into the intercompany framework and enable the advanced features. All of these features are, so here under the, if you have intercompany time and expense.
Peggy, we
Wait,
don't see your
wait, I don't
screen.
think we see your screen.
Oh, now you, okay, hold on. It's been one thing after another with this. Okay, sorry about that. Let me try. I thought it was sharing, so just a minute. Okay, now I can't get Zoom to come up. Okay, there we go. All right, share screen. Okay, we're gonna try this again. This has been technology hell. Okay, so we're gonna start here. Okay, now can we see my screen?
Yes, you're on the
we can
NetSuite
hear me.
setup slide. Yes.
Okay, all right, so the first thing you want to do is enable the features in the advanced features. The key features here are the automated intercompany management and intercompany framework. Here, this one is set up with intercompany time and expense, but it is not required for eliminations. Automated intercompany dropship is also not required for eliminations. However, the automated intercompany management and the intercompany framework are both required values. So the next piece then we have to set up are the intercompany frameworks, the intercompany preferences in NetSuite. So if I go into NetSuite, it feels like it skipped a slide. Okay, there we go. No, this is the right side. All right. So the next thing you have to do is go into setup, intercompany preferences, and go to the accounting tab. What this permits you to do is set up default receivables, payables, income, and expense. Now you'll note here that the receivables and payables accounts are, oh, I don't have a payables account here, but you would need to set that up as a default. In this case, they're just running everything through intercompany receivables, but you will want intercompany receivables, intercompany payables. It is important for elimination purposes that if you have intercompany income and intercompany expense, so one entity charges another entity for anything, really, that be booked to an intercompany account. And we'll see in a minute why the intercompany account piece is really important. It's because basically you designate that these are intercompany items and you designate accounts for elimination. Here you can set up a trade currency. A trade currency can be important if you're doing intercompany transactions, because it basically says, I will do all my transactions in this currency for intercompany. So if you have a situation where your intercompany agreements are set up to where they will always use a specific currency, so they'll always use the dollar, for example, you can set that up here as a default. For cross charges, it's saying that you are going to do a journal for doing the cross charges. So that's when you do intercompany items on a line item where you are going to cross charge that item to another entity. And in this case, we've got it set up to post summarize as opposed to detail. There's also an item here, allow per line classification for netting settlement. So what netting settlement is in NetSuite is you have the ability, if I have an intercompany payable and an intercompany receivable between company A and company B, at the end of the month, I can do intercompany netting. So what it's going to do is it's going to say, I am company A. Company B owes me $100. I owe company B $100. If I run the intercompany netting, what it's going to do is it's going to take the amount that I owe company B and offset it against what they owe me. So at the end, for reporting purposes, I'm just showing that company B owes me $50. So from an accounting standpoint, it is a very useful tool to have, because a lot of times people complain that they have to do that netting manually, otherwise they're grossing up both the asset and liability side of the balance sheet. So this permits you to not have to gross things up and do that transaction automatically. The next section is the transfer pricing method. If you're doing transfer pricing, you can choose a transfer pricing method and choose a markup. This is if you are doing intercompany sales. There's more complexity under the hood around selling inventory across entities, but this is one of the features where you can actually set up the markup rate. This one's particularly important. This is setting up representing entities. So NetSuite, I think it was in 2022, put in a feature where when you set up a subsidiary, you have the ability to automatically set up an intercompany payable and an intercompany receivable customer and vendor for that entity. They are marked as representing entities, and the system knows that when you select those entities, you are referring to intercompany items. So what this preference does is it says automatically generate representing entities and then put this prefix in front. So that means when I create an intercompany customer or an intercompany vendor, it will automatically put IC in front of it, so that if I go to my vendor list or if I go to my customer list, I can immediately go down to the intercompany customer or the intercompany vendor, and I'll see it right there. I know it's an intercompany customer. I know it's an intercompany vendor because I've put IC in front of it. So it groups them all together and makes it easy to find them. So here are your representing entities. Here's an example. So here, what I did, because I initially had to start this up and there were already existing subsidiaries, if I'm starting up this process, I can go in here and I can set up that prefix on the last screen. I can set it up to automatically add the representing entities. However, that only will apply to new entities. So if I need to set them up from scratch, and then the new ones will automatically get these allocated as time goes on, I'm going to hit the generate representing entities. And here you can see my intercompany customer and my intercompany vendor. So it's going to grab the name of the entity and just put IC in front of it. So I know that if I'm looking for a vendor and I see IC Canada, that is the Canada subsidiary that is in that guise a vendor. Or if I look at customers, that is Canada as a customer, because obviously on one side of the transaction, they will be a customer. On the other side, they can be a vendor. So depending on which way the transaction is going. So setting this up is very important, because NetSuite is going to rely on these values in the transactions to determine how to eliminate. So there are some prerequisites to setting up the representing entities. First of all, you must set up the multi-subsidiary customer feature. That is absolutely mandatory, because if you think about it, your customers, an intercompany customer by definition will probably represent multiple entities, because multiple entities might be using that as a customer, insofar as you have different entities that interact with each other as opposed to just one entity that is interacting. The other item is that you need to make sure multi-currency customers and vendors include children. So remember, these are items, or these are customers that need to be across all of the entities because you could be charging across all of the entities. It doesn't make sense to pick and choose in this case and say, well, this company's never going to do business with this company. Never's a really long time. So it's really a best practice to just set it up to make them available. And then if they use them, they're ready to go, as opposed to just setting up a few of the currencies or sorry, not currencies, but a few of the customers with specific entities under the assumption that they'll never go outside that framework. Because invariably at some point they will, and then you've got to backtrack and figure out why it's not working. Because you may not immediately instinctively think of going back and looking at the customer and seeing if they are all set up for all of the entities. So when you set up intercompany accounts, these are the key things you need to do to set up an intercompany account so that it will eliminate. Now keep in mind, when I talk about an intercompany account, I'm not just talking about a due to and due from. I'm also talking about income and expense accounts. I'm talking about potentially long-term investments. I could be talking about a long-term investment in subsidiary on the equity or the asset side of the balance sheet that is offset by an investment from parent that is on the equity section. Both of those still need to be eliminated because otherwise they're grossing up those sections of the balance sheet, but they are not traditional due to, due froms. However, they can still be set up to eliminate. So what do I need to do in my account? I need to make sure that the eliminate intercompany transactions box is ticked. I need to make sure the include children box is ticked. I need to set up, this is really important because it has long-term ramifications if you don't do it this way. Set up the intercompany payable, the due to, as a payables type. Set up the intercompany receivable, due from, as an accounts receivable type. That's really important for settling transactions and appropriately accounting for any gains and losses that might arise due to foreign currency if you have foreign currency. Other account types, as I mentioned before, can also be set up to eliminate. So first polling question. Corey, can you put up our polling question, please?
Yeah, just a minute.
So which box is required to be checked to set up an elimination ready GL account? Is it the revalue open balances for foreign currency transactions? Is it the inactive? Is it the eliminate intercompany transactions? Or I don't have to check any boxes. So remember, as I set up my accounts, I'm going to want to make sure that I have designated that they need to eliminate.
Wait about 20 more seconds here, Peggy, if that's okay.
Sure. So I'll just point out, you don't have to answer the questions right. You just have to answer them to get credit for CPEs.
All right, we'll go ahead and end the poll. Share the results.
Okay. Yay.
And there is a question
Mhm.
from Susan Sweeney. She says, what if we're using the same account for due to, due from? It can't be just AR or AP.
I mean, that's usually you pick one of the two. It's fine to do it that way. I also see people doing it as an other current asset or an other current liability. And Suzanne, things have changed somewhat in NetSuite since we set all that up. So just so you're aware, but you still are able to settle those items as needed. And I don't remember if you have an AP or an AR type for those accounts, but you can still choose to use just one account. You have to obviously decide what the main account type is going to be. Is it going to be an accounts receivable? Is it going to be an accounts payable? Is it going to be an other current asset and other current liability? But you can still manage it. The key thing is that if you're going to eliminate that account, you must mark it as an eliminate.
Right, and I'm just thinking, Peggy, you and I probably need to reconnect and check
Yeah.
my settings because all the stuff is so different.
It's changed a lot since we did your initial setup.
Okay,
So don't feel bad. We did it, I think, like 4 or so years ago before they brought in some of this eliminations, these additional the additional functionality. So anyway, elimination companies. So in order to eliminate, you need an elimination company. Matt Ballas, when I had gotten back on, was still messing with my audio. Matt had been talking about elimination companies and why they're important. And to reiterate, an elimination company, first of all, it is necessary to have an elimination company in order to be able to use the elimination process in NetSuite. Eliminations are a place where you can go, you have its own company, so you can still run all of the individual subsidiaries standalone, but when you consolidate, you can get rid of any intercompany items that would gross up areas of your income statement or your balance sheet and should not be included for a consolidated presentation of your financial statements. So, an elimination company, it does not use a country currency license. That's really important. So there's no limit on the number of consolidation companies that, or elimination companies that you can have, and it doesn't chew up licenses. So that part's really important. The second thing that is very important is to figure out where your roll-ups and elimination points should be for consolidation purposes. So we know that we need an elimination company at the very top. That is mandated by NetSuite. But depending on the complexity of setup, what is going to be necessary down the line? So let's say, for example, I consolidate to a US holding company, and underneath that I've got 2 or 3 companies, one of which is a European holding company that has European subsidiaries underneath it. So between the European subsidiaries, they have intercompany transactions. So in the roll up to the European entity, to be able to report the European entity appropriately at a consolidated basis, I will need an elimination company there. Then I will need an elimination company flowing up to that US holdings, because the US companies that are under the US holdings and that European company that's under the US holdings could have transactions between themselves that would need to be eliminated. So in this particular scenario, I have 2 levels of elimination, one to that European holdco and then one to the parent holdco. So it's important to sit down and look at your legal structure from a consolidated reporting standpoint and figure out where you need to be eliminating for statutory reporting on a consolidated basis. Now, that doesn't necessarily mirror your management structure. We're talking purely from an accounting standpoint here. So you may have entities that roll up into regions or this, that, and the other thing, but for elimination purposes, you are looking at how it needs to be reported from a statutory standpoint. So that part is really important. When you set up the company, you go in, set up company subsidiary, select the correct parent subsidiary, and mark the elimination box. Once you set up an elimination entity, you cannot change that parent subsidiary. So make sure you get it right the first time. That part has been a challenge for when people change their subsidiary structures, which can happen, and NetSuite does support it. There is a box that you can tick, and it gives you, I think, 60 days to change it around, and gives you all kinds of warnings about how it's going to affect your historical reporting and so on and so forth. The tricky part there is it allows you to change the roll-ups on your transactional subsidiaries. It does not allow you to change the roll-up on the elimination subsidiary. So that part can get a little bit difficult if you're having to change subsidiary structures, and it's definitely a caveat. So I know that when I've had to change that in the past, I've had to go through and create new elimination companies and inactivate some of the old ones because they were no longer pertinent. So this is what that looks like. This is an elimination company. Here's a screenshot. And you can see I've named it something. Here's my parent subsidiary. Here it's, now notice it's ANZ. So my headquarters is Australia. The country is Australia that it's rolling up into. And if you'll notice, the currency is the Australian dollar. I do want to point out that the elimination entity will, default the currency to the currency of the parent that it is rolling up to. So in this case, I have it rolling up to an Australian entity. So the currency for elimination is the Australian dollar, because the assumption is it is rolling up from Australian entities underneath it. So in that example that I gave earlier with the parent, that's a US dollar company with a European holdco with some European entities underneath, the assumption there is that those two European entities are euro. They roll up to a euro holdco. And so the elimination company that's going to eliminate between those two European entities will be in euros. And then the holdco and all of the elimination, or all of the consolidation, when it rolls up to that absolute USD parent, will convert to US dollars during that consolidation. Gets a little bit tricky there when you start throwing in subsidiaries under the parent that are in a different, that consolidate in a different currency than the parent. So that is something to be aware of. You get to the right answer all the way at the top, but keep in mind those intermediate steps. Those elimination companies are going to default to the currency of the parent company that you assign when you create the elimination company. All right. One of the key ways to get transactions in from an intercompany standpoint is the advanced intercompany journal entry. There are some key fields on this entry that you need to make sure are filled out when you go in and create that entry. So here, for example, you'll see that I have prepaid expenses. I have an intercompany receivable for Canada. Notice the subsidiary up here is Canada. You must make sure that the first line of your entry agrees to the subsidiary you've selected in the subsidiary field on the entry. This is Canada and Mexico, and so, you might think, oh, I can enter the lines for Mexico first. No, you can't. You must enter the lines for Canada first because the subsidiary that you've selected on the intercompany entry is Canada. So here I have a receivable in Canadian dollars, which I didn't show up here, but the Canadian dollar is the currency of record for Canada, for the Canadian subsidiary. So here I am taking out prepaid expense that I paid on behalf of Mexico. And I'm saying they owe me for that because I paid for it. And here they're expensing it and they're acknowledging that they owe me. So here, my customer, this is my intercompany customer because it's a receivable. And when I go in and do the actual drop down, I will only be able to pick customers. So here my intercompany customer is Mexico. And here, this one's super important. Eliminate yes. Because this is how it knows to go in and select those transactions to eliminate. Down here, this is the counterparty with Canada. So this is Mexico's side. Here's their payable. This is the intercompany vendor, which is Canada, because Mexico owes Canada. And again, eliminate is marked yes. It will default these to yes. You can untick these, unfortunately, and you can post them. And the problem there is that even though it will give you a warning, it will let you proceed, and you can end up with entries that are not balanced from an elimination standpoint. It'll warn you that your entry is not balanced from an elimination standpoint, but it doesn't actually stop you from doing it. Okay, second polling question. All right, so what value goes in the name field of the advanced intercompany journal entry on the intercompany and account line? So think back to that last slide where we had the screenshot. So what am I going to put in the intercompany line? So what value? So is it the representing customer vendor for the destination, or is it for the originating? So think back on that last screen that we looked at. How are we doing on the poll, Corey?
Okay, we'll go ahead and end it at this point.
Okay. So it is for the destination entity. So if you remember on the receivable line of that last screen, we had the receivable. Remember, it was Canada. Canada had the receivable. And if you remember, the customer was Mexico. And then on the Mexico line, you had the payable. And remember, the vendor was Canada. So the way I always like to think of it is, okay, here's my entity in the first column. That's the entity that I'm booking this for. And then in the name, I need the entity that's the other side of the transaction. So as long as those two don't match, I'm good. If I try to make them match, I'm doing it wrong. Okay.
Peggy, we have a
Yes.
whole bunch of questions. I just think maybe the
Oh,
questions
okay.
should be weighted, maybe wait until the end with the Q&A. There's just so many.
Okay. All right.
I mean, you can look through them if you want, like
Well,
Priscilla's
I
asking.
don't have a second screen, and so
Yeah, you
I'm
probably want to
Oh.
wait till the end.
Yeah,
But yeah,
just because
some
there's so
questions.
many.
okay. That's fine.
And for
yeah.
those of y'all asking questions, we'll probably address them at the end. So just heads up.
I will make sure to address any questions as needed. So, all right. This is what an elimination journal entry looks like. So elimination entries can be posted either manually or by the system. if there's something that happened that's wrong, you might need to post elimination entry by a manual process. Elimination entries are posted to the elimination companies, and they are posted by going to transactions, financial, make journal entries, and posting to an elimination subsidiary. The minute you choose an elimination subsidiary to post to, by definition, makes it an elimination entry. Now, the system entries will automatically reverse. However, if you book one manually, you will need to tell it to reverse by putting in a reversal date. This is what an automatic one looks like. So over here, I've got all my ins and outs, my debits and credits, my intercompany receivable, my intercompany payable. This one is getting rid of a due to, due from, and this is where I have the elephant in the room. The CTA-E account is designed solely for a place to put an out of balance between the debits and credits on an elimination entry. It will do your elimination entries separately. It will do one for your balance sheet and one for your income statement. Your balance sheet, that CTA elimination, the CTA-E amount should be minimal. It should be very small. Here, it's not very small. That is the canary in the coal mine. If you are booking automated intercompany eliminations and you see a large amount in the CTA-E, particularly on the balance sheet entry, it means that you have an out of balance with your intercompanies. Your intercompanies can be out of balance for a few reasons. Number one reason, are you running revaluation on all your foreign currency items? Number two, are you booking things using an advanced intercompany journal entry and making sure they're marked to eliminate and getting both sides of the entry that way? Reason number three, for some reason you're not using intercompany journal entries, you are booking intercompanies separately to each company through standard journal entries, and you have not booked both sides. You can, in fact, book a journal entry and mark it to eliminate. However, it does not book the second side of the entry, in other words, the corresponding entity. So if you do it that way, you would only do those in order to fix a problem on one side. You should not be doing that as a standard process. You should be using advanced intercompany journal entries or using the transaction line distribution to create the intercompany entries if it is something like a vendor bill. So that part's really important. If you are seeing $36,000 on these comparatively small amounts here, there is something missing somewhere. And then you have to go back and figure out where the missing items are. So, elimination considerations. First of all, revaluation should be run for intercompany accounts prior to eliminations being run. That is assuming you are using multiple currencies, but in a lot of cases at this point, people who are using this feature have at least one subsidiary outside the United States that is denominated in a currency that is not the parent currency. Intercompany accounts should be reconciled prior to running revaluation in order to prevent errors accidentally ending up in CTA-E. In other words, before you run eliminations, make sure your intercompany's balance. If I have an intercompany payable and an intercompany receivable, do they total to zero when I add them together? They should equal each other or come very close. because the difference in that's going to end up in CTA-E. The CTA-E entry will occur automatically if there are revenue and expense items in companies that do not share the parent's functional currency. This is a place where you can legitimately get CTA-E. However, these amounts should not be large. If you remember on the last slide, I talked specifically about a large out of balance arising from balance sheet, from the due to, due froms. And if there were elimination of investment subsidiaries, those should match as well. Unless your accountants tell you that your investment subsidiary should be at current and the other subsidiaries, common stock or investment from parent is done at historical. You may get some little differences there. That's a nuance, and I've seen that before. Nonetheless, those should not be large amounts, and those should be readily, easily identifiable. So you absolutely want to make sure that those are balancing before you run reval. And then when you run your income statement, you'll be able to see on a consolidated basis before you run the elimination, how much is my intercompany revenue? How much is my intercompany expense in dollars? What's my difference? I'm expecting a little bit of a difference when I consolidate. And at that point, I will get a little bit of CTA-E when I actually book the elimination entry. However, again, large CTA-E entry is a warning sign that something is seriously out of balance and needs to be investigated. That's why I say you should always reconcile your intercompany balance sheet accounts before you actually run revaluation. And when I say reconcile, make sure that the base currency amounts match. In other words, if company a US dollar company, thinks that company B owes them $5,000, company B is a euro company, company B should have booked that $5,000 in US dollars and allowed it to translate that transaction. That way, when company B revalues, it is revaluing 5,000 US dollars. And when it consolidates, you will see that company B owes company A on a consolidated basis $5,000. Company A knows that it's owed $5,000 and they eliminate. What you don't want to happen is company A is owed $5,000 from company B. Company A books it as $5,000. Company B books it at 4,800 euros. They will never balance at that point. So you want to make sure when you book your intercompanies that you book them in the same currency, which will automatically happen if you use the advanced intercompany journal entry. So when you check your intercompanies prior to running reval, check them in the currencies that the transactions were done in and make sure that the balances balance on a currency by currency basis, particularly if you have due tos and due froms, where there are transactions in multiple currencies. Otherwise, they will not balance appropriately. So next quiz question. What is not an element of CTA-E?
And Peggy, just for reference, these are the three that you sent me. There's not a fourth one.
So you need to answer all three. I didn't have a fourth. Sorry about that.
Okay.
I didn't realize I didn't have a fourth in this deck. All right, so what's not an element of CTA-E? This one might take a little bit of thinking. CTA-E, not CTA. And I'll talk in a minute about what the differences between those two are.
So leave this up for about 5 more seconds. It's the final poll. Okay, I'll go ahead and end the poll.
Okay. Okay, and the answer is number 3. Differences arising from translation of subsidiary financial information into the parent company's currency. That goes into CTA. So what's the difference between CTA and CTA-E? CTA-E, also standing for CTA elimination. Some people will call it OCI, so other comprehensive income. It goes in the equity section of the balance sheet, but on the elimination company only. And its only purpose in life, only reason for living, is to put any out of balance amounts that you have arising from creating elimination entries for your intercompanies. So differences arising from out of balance intercompany accounts go into CTA-E. Differences arising from intercompany revenue and expense items go into CTA-E. Differences arising from translating the trial balance of a foreign subsidiary whose currency is not the parent subsidiary goes into CTA. The CTA is on that translated set of books, not in the elimination company. So when I take, real quickly, when I take a trial balance from a foreign subsidiary, I translate the income statement at the average rate of the month. I translate the balance sheet, except for the equity section, at the rate on the last day of the month. And I translate the equity section at the historical rate on the date that the transaction occurred. The result of that is if I take a trial balance that is in balance in the local currency, in the functional currency, and I now translate it to the parent's currency, which is different because I am translating different elements at different rates, it no longer balances. It needs a place to put that out of balance amount. And that goes in the CTA account, which is in the equity section of that foreign subsidiary's balance sheet when it is translated to the parent currency. So if I run the balance sheet in the local currency, I should have nothing in CTA. If I run the balance sheet in the parent currency, I will have CTA because it is translating my elements differently. And that is why this answer is correct for this question, because I am asking which is an element of CTA-E, not CTA. Okay, we can go through those 38 Q&A questions now, and I'm going to go ahead and show them on my, okay, where is the first one? Let's see. Okay, the recording, okay, first question, the recording gets shared on our website, RockyMountRMNSUG.org. And you answer that. Okay. What if you want to sell profit at a product at a profit to your partner subsidiary? It's still going to eliminate from an elimination standpoint. So if you recall, we talked about markup there. So I'm basically saying I have product A that I am selling at X amount. So my cost of it is $100 and my sale price is $120. So if you look at my entry, I'm going to go sales versus cost of goods sold. One, you're going to have sales on the parent side for 120, cost of goods sold for 100, but then on the flip side, you're going to have the cost of goods sold for the, I could go through, but long and short of it is, as you go through the T accounts, they're all going to, it's all going to eliminate. because I've got an intercompany sale on, it's intercompany sale versus AR on parent company. On receiving company, it's intercompany COGS versus payable. So if they're selling it at $120, it's going to show a sale of $120 on parent and a cost of sale of $120 on the subsidiary. Now the tricky part is if it goes into inventory, you've taken it out of inventory at 100 and put it in at 120. If you use the intercompany sales order and purchase order process and address the markup there, it will eliminate that out as well.
Peggy,
Yeah.
we're just seeing the slide that says Q&A. Can you
Yeah.
show this in a fake journal entry that you don't actually save, but can you do that? Because
No, because I don't have the whole, it's more complicated than just showing a journal entry, because
Oh.
that elimination is going to happen from the fact that I've created an intercompany sales order, intercompany purchase order, I've fulfilled those.
Okay.
And so it's going to create a number of entries there, including the entry that I'm going to need to eliminate, including that markup.
So
So
only the Q&A screen is showing, right? Nothing else.
Right, yes.
Okay.
I'm not showing you an entry.
There's a question on that, so thank you.
Yeah. No, I'm not showing you an entry because I can't show it just as a simple journal entry. Okay, all right. Let's see. Okay. How does NetSuite limit the intercompany profit from items inventory? Again, okay. It'll eliminate, right, it won't eliminate the inventory, it'll eliminate the revenue and expense. Matt, thank you for answering that. If you've got stuff that's buried in inventory, you end up frequently having to do an adjustment around that if it's grossing up your inventory. Will any of these features work for a class-to-class relationship? I'm not sure what that means.
Jacques,
So
are you
we-
still on?
Yeah, so we're set up, instead of all of our individual entities being at a subsidiary level, we're all set up at a class level with 2 or 3 main subsidiaries. And most of our relationships that are intercompany are between the classes rather than the subsidiaries. So I was wondering if there's any way to have this system work more at a class level than a subsidiary level.
No, I don't
Okay,
know of
thank
any
you.
way to get it to eliminate on a class basis within a subsidiary.
I've seen it done, but it was a customization that took a lot of development time to
So
set
there you
up.
go.
Yeah, but it's not common or easy. It's big
Not native
customization.
NetSuite is what we're saying. Okay, I apologize for the letters in the presentation being too small. Okay, let's see. Suzanne, I answered your question and we'll talk offline. If we've been old, so if you've been using the old settings, so you can set up the new settings. And it's pretty straightforward. Just go in and set up the representing entities, set up the your elimination subsidiaries, set up the intercompany framework. The thing that you could run into if you have not set up your intercompany accounts to eliminate, you cannot tick the box after those entries have been made. So if there are entries on your intercompany payable or receivable and the eliminate box is not marked, you cannot go back after the fact and mark it. It will give you an error. So in a lot of cases, that means that you need to create a new account and bring over those old items into that new account and mark those to eliminate. That is one time where you can do an entry to an intercompany account and not use an advanced intercompany to do it. You have to make sure that the form has the two subsidiary, so you might have to customize your JE form. And you need to make sure that in the classification section, the two subsidiary field is exposed. Then you can go in, you can put your representing entity in, you can mark your box. So what you would do, so let's say I have an intercompany receivable account, it's not marked to eliminate. I'm going to set up a new intercompany receivable amount or account. And what I will do is I will credit the old account for, say, $10,000, whatever the balance is. And then in the new account on that same journal entry, I'm going to go, okay, item A is $4,000. And I'm going to put my intercompany, who that's with, and I'm going to mark it to eliminate, and so on. And what it's going to tell you, that's where you can get that warning that says your intercompany eliminations don't balance. And that's fine because they're not designed to. So it is depending on how much of the process was done initially. It's depending on what point you started using intercompanies and at what point you decided to do eliminations or maybe didn't is going to depend. That's going to be what drives the lift to fix those. To make it current. Okay. Yes, the elimination box is grayed out and can't mark it. Yeah, exactly. Matt, thank you. Oh, so in the GL, in the subsidiary setup, not the GL setup. So you don't mark, so are you trying to set up a new elimination entity? You don't go back and change entities that you already have in place. If you've set up an entity and you have transactions in it, you can't change it to be an elimination entity. If it's functioning as an elimination entity, but you didn't set it up that way, but you're doing something to where you're manipulating in Excel or what have you, what you would want to do is move those elimination balances to an actual elimination entity and inactivate that entity that you were sort of using as an elimination entity without having it be set up as an elimination entity. But you would normally set up a new elimination entity and you would mark the box. If the box is grayed out when you're setting up a new entity, let's talk offline and we'll troubleshoot what's going on there. Because if you have all of that stuff marked in that beginning slide, it should all be set to go. So I don't know why at that point it would not allow you to set up an elimination entity. Matt, have you seen that before?
Would not allow it to set up an elimination entity?
Yeah. Mm-hmm.
No. The representing subsidiary field, like, I've seen it hidden on forms, but once it's exposed, you should. But what I will say is, like, ideally, you use the auto-generated entities for a multitude of reasons. So if you're manually creating your own intercompany customers and vendors, it could be tricky to manage, whereas the auto-generated are great. But also the auto balancing, which we didn't touch on. So if you have a defined intercompany AR, intercompany AP, and the only intercompany vendors and customers are the auto-generated, then when you use the auto balance feature on advanced, it'll populate the intercompany AR and assign the appropriate customer in the name column. But even if you have another customer that was created that's already been used as intercompany, then you've lost that ability because you obviously can't get rid of that customer. It's got history. And so NetSuite's not going to know what customer to assign.
Exactly. Here, I'm going to go in and I'm going to just let me get onto my my One World demo account here. And I'll show you on transactions, financial, advanced intercompany journal entries. Everybody can still see my screen, correct?
Yes, you're in NetSuite and
Oh, good.
yeah,
And
multi-book
it's
world.
trying to bring up a there we go. So in the intercompany, there's a button here called auto balance. So what I can do at that point is I can put my subsidiary and my account, my expense account. And then I can put down below. So here, let's say I choose I do. So let's say I'm doing Canada. Here I'm saying I'm selecting Canada and I'm debiting an expense account. Say $5,000 or $50,000. And then my name over here is going to be, oh, it's not intercompany. So, so now what I'm going to do is I'm going to say Mexico. Okay. And then if I auto balance, no, I don't have a payables account set up. I can fix that really fast. Set up, accounting, intercompany preferences, receivables, intercompany receivables, and the payables, intercompany payables. So that's why you want those set up, because then I can go in transactions, financial, make advanced intercompany journal entries, subsidiary, Canada, 6110. I don't actually really care what account I'm hitting. I just want to show this functionality. Auto balance. Fix the transaction date. I did that. Okay, I'm not sure why it's because I set that up. However,
Oh, it's under it's the accounting. So it's confusing. It's the accounting preference, not the intercompany preference.
Gotcha. Sorry.
Yeah. So it's like near the bottom of the accounting. There you go.
There it is. Sorry.
Yeah, it's confusing because there's two places you define the items and transactions, and then
Oh, that's right. Oh,
it should be near the very right there. Those last two. This is default ICJE auto
oh,
balance.
okay. I this is here's my problem. This is a new instance. NetSuite took away my old one. And so I'm missing a bunch of stuff in here. So setup, you're going to see how we actually set it up here. So setup accounting, enable features, accounting. Let's make sure that I've got, okay, that's all set up. And then set up accounting, intercompany preferences. Over here representing entities. I see dash. Save. It's not letting me set up the it's not letting me set up the representing entities. Set up company. Enable features. Oh, intercompany framework. There you go. You have to set up intercompany framework. Which I thought I had seen. But, okay, so I should have everything now. Now company, subsidiaries.
While she's setting these up, I'll tell you some other things I will see as far as like the account types that is chosen. So you often will see like tracking like multiple due to do froms for each one. That
Mhm.
becomes very difficult to manage, right? You don't necessarily need that. If you have one due to do from account, then by assigning those representing entities, right, you can run reporting to know who is the counterparty on that. And then also, as far as whether or not it needs to be accounts receivable or accounts payable, did you turn on the multi-subsidiary customer?
No, maybe not. I'm trying to do this too fast and not following my own.
I think, yeah. But if you use intercompany and vendor bills and customer invoices, then you have to obviously then have a accounts receivable and accounts payable account type. If all of your intercompany is done through an advanced journal entry, it's not necessarily required. In those instances, you know, you can have one intercompany that's an accounts receivable account type, in which case it makes it easier to track that everything is balances, right? Because if everything's going to one account, if you did everything correctly, even before running eliminations, the balance should be zero. That's one benefit. Also, AR and AP account types, if you have foreign currency, then that allows you to recognize realized gains and losses for
Mhm.
when you settle those. Whereas like these other accounts would just be perpetually sitting in unrealized gain or loss because only AR and AP can recognize a realized gain. All right, that is enabled.
Yeah,
Is multi-currency?
yeah.
Yeah. What is the accounting one again? So what is the automated everything's too?
I mean, all the stuff's set up.
Maybe it just takes a second.
Maybe it's a demo account that they gave me that's being difficult because if I go to my intercompany preferences, those are set too.
And this is so great out here in the representing.
Yeah. Because I've got the representing. Oh, there we go. Now it's not grayed out anymore. That took a minute. Because I'd gone back and checked it. It's like, okay. So now if I go to set up company subsidiaries, I can go and to generate representing entities. And now it's going to take a minute. So you can see the progress. Oh, so if you already have one that's set up, so let's go back and see what's going on here. Okay. So now they're all set. Now notice it doesn't do anything for the elimination ones because you don't have intercompany items that go into, you don't have an intercompany item between an entity and an elimination entity. So now I can actually go back to transactions, financial, make my advanced intercompany journal entry. I'm going to change the date this time. And there, I'm going to choose my Canadian subsidiary. Canada account 6110, 5,000. Mexico. There we go. So now you'll see what it's done is it's gone in and put in your intercompany names and the to do from with the intercompany payable and the intercompany receivable account. So that's how you can automate that. You can just put the subsidiary, the account that you're hitting, next subsidiary, the account you're hitting, hit the auto balance feature. And that was a little long-winded to get there, but as you see, you can do it. All right, where's my next question? So no, I'm not going to show a standard sales order and purchase order in NetSuite with profit right now because there's a bunch of setup I need to do under the hood. You have to set up items appropriately. You have to set up items with intercompany sales and COGS accounts, and I don't have this particular instance set up. At some point, that might be a good thing to do is go deep dive into intercompany transactions. This was really designed about eliminations, but doing a specific deep dive on intercompany transactions, showing the newer feature of the line item distribution and how it works to do that distribution with the new feature at month end, as well as talking about doing intercompany inventory transfers, intercompany sales and purchase orders. It's a complex topic, and I am not set up to do it in this particular session, but I think it's a good one to maybe put on the list of things to do. And Matt, you seem to, can I throw you under the bus and see if maybe you'd be interested in presenting on that topic?
On which one?
A deep dive of intercompany transactions.
Sure. Yeah.
Okay.
I think
Maybe a few months.
yeah, I think it's always great to have use cases. Obviously I know a
Yes.
few, but yeah, if you send those in as some use cases or scenarios you'd like to see how they're done, then yeah, I could do a walkthrough. I was gonna even mention one that a common one I see. Now, foreign currency is always what adds that layer of complexity, but you know, intercompany cash transfers to like a foreign account being done on advance, right? So if you're if this US in this example, you're transferring like Canadian dollars to Mexican pesos, if both bank accounts are denominated on the advanced journal, then you're going to be putting Canadian dollars in a peso account, which means it gets revalued. And so in that case, you would want an intercompany clearing account. So on the Canadian dollar denominated advanced journal, you're not impacting a peso account. But yeah, that's just one, that's a common one I was going to bring up. But yeah, I think if we have a session solely on
Intercompany, yeah. Intercompany transaction processing. Because it's getting, the features have changed in NetSuite for the better, you know, the out-of-the-box features, because there was a point where they had gotten rid of the shared transaction feature, but there had been nothing that effectively replaced it. And then you have the line item distribution piece that is serving to replace that. And but knowing how to use it is the trick, because it is fairly recent. So, right. So I'm getting an error when I click generate representing entities for all the state of the inactive field on the representing entity must match the corresponding field on the representing subsidiary. I've never seen that one before, because you're creating new ones. Do you have any that are already set up, and that, or do you have any entities that are inactive that it's maybe trying to set up representing entities for? So that's what I would look at. Are there any questions? There were a lot of questions in there. Are there any questions that I've missed? You can unmute yourself and talk directly. That might be easier.
Yeah, I've got a question, sorry.
Yeah.
I know we do a lot of intercompany sales, and you
Mhm.
said there is an intercompany income, cost of goods sold, and expense accounts. I don't want to, we have lots of different types of revenue going to different general ledger accounts. So I want to show, I don't want to show a one line intercompany revenue. I want to make sure it's
You can set up
allocated.
multiples.
Okay, and then I
As
just
long as they are set as intercompany so they can eliminate.
okay, but can I not just on the general ledger account for most of my income, because we would have most of our income could be intercompany as well, just tick them to
You have to
eliminate?
segregate. You have to segregate if it's an
Yeah.
intercompany sale.
Yeah, if you pull up an item, so that's what I was trying to reply. So
Yeah, sorry, yeah.
Karina, so the on an item record, right, you have an income account and then you have an intercompany income account. NetSuite does not allow for those to be, you can't have two account fields on an item that go to the same account. It's going to insist that you, so that's where I was mentioning, like, if you do need, so like, let's say you have 4 different primary revenue streams and you can create 4 intercompany accounts, and they can also be contra accounts of the actual ones you want to represent, but they should be segregated. And item reporting would still give you that additional layer of detail to know like what service, even if it's a service revenue account,
Okay.
the item could tell you specific services you provided without necessarily needing multiple.
Having the different ones.
Right.
Okay.
So going to One World, Matt, you've done One World. How hard is it? I don't think it's hard.
Well, so it depends on if you're just doing it to produce consolidated financials, it's not hard at all. So you get it, you buy it, it's provisioned. There's some implications to roles and things like that, and the chart of accounts, but the tricky part with getting One World is getting balances in, right? So if these other entities that are not in your instance today, you want to get One World to bring them on. Well, are they going to continue to transact in parallel in this external system, and you're bringing over monthly trial balances? That's easy enough, right? You just have to map their chart of accounts to yours, bring over the monthly trial balances, and then you can get consolidated reporting out of NetSuite. Now, if they're going to stop using Sage and come onto your NetSuite account and operate within that subsidiary, that's obviously a much bigger, that's a full-on like implementation at that point. But turning the feature on by itself, it's pretty easy, right? It's pretty painless. It's just thinking through roles, who has access to these accounts, and then I mean, that's pretty much it. I mean, so we do it pretty often.
Does that help, Roy? And
does.
a benefit, it's not a heavy lift, but yeah, it does give you the benefit of intercompany transactions.
Thank you. Yeah, it does help. I know there's a lot of devils in the details when it comes to enabling a feature. Thank you all.
Any other questions?
Sorry, I just got one. This is again on the intercompany sales. Could I manually eliminate if I do want the intercompany sales? I don't want to set up a separate GL account.
Yes.
Intercompany GL. Could I,
Yes, you
I
could.
can run a report and then manually eliminate them.
Yes, you could.
Okay, thank you.
So yes, so just to confirm, you are able to either run eliminations automatically and have the system do it, and or in combination, you can also put in a manual entry. So if I want to create an entry that is in my elimination company, all I have to do is go to transactions, financial, make usually book specific journal entry, I believe, for eliminations. And then I select my elimination subsidiary.
Okay.
And I book it like any other journal entry.
And then the intercompany balances would still eliminate. I
Yes.
wouldn't have to do that.
So
math.
you
Yes,
can
okay.
still, so let's say I'm eliminating, because in this case, what you're saying is you're eliminating from a company that is not, or not, excuse me, an account that is not set up to eliminate.
Yes.
So what you're going to do is you're going to manually put an entry in to eliminate a portion of that account.
Yes.
And obviously you are eliminating the
Corresponding
same amount
expense.
theoretically on the cost of sales side as well.
Yes. Yeah. Okay.
Okay.
Great.
Yes,
Thank you.
you can do that.
Okay. Thank you.
Anything else? Okay, well then, I'm gonna go ahead and wrap up. I apologize for the technology problems. It appears that I have not had super great connectivity. I'm not sure why, because I'm at an office that has, good connectivity, but I do apologize for the fact that Zoom kicked me out at one point because my internet died and I had to get back in. We will be collating all the information for your CPEs and sending out the CPE certificates, again, figure 6 to 8 weeks. And a special call out to Matt, who covered for me while my internet was fighting with me. Thank you. And just on an ongoing basis, the board will go back and regroup and talk about doing a special presentation just as a deep dive on how to do intercompany transactions, because it's a meaty topic. There's a reason in this particular session that I don't talk about. And no, you don't need a CPE code. I'll explain the process in just a second. But basically, with the intercompany items, setting up so that you can do an intercompany sale and an intercompany purchase of inventory items is a heavy lift in itself, because there are a bunch of things you have to set up for the items themselves and how to do it. So the way the CPE code works, or CPE works here, is you don't need a CPE code. The way it works is participation in the polling questions, and you're having been online for the session during a minimum of an hour or 50 minutes of the session. So you don't need to, basically you don't need to do anything. If you've answered the polling questions, you're set. Oh, a one world implementation do's and don'ts, so I wish I would have known. Yeah, that's that's an interesting topic as well. That might be good to talk about at some point.
Yep, we'll put that on our list. We have an ongoing list of meeting topic ideas. So yep. So thank you, Peggy. Thank you, Matt. Thanks for everybody for being here today. Really appreciate the time and the presentation. The presentation and the slides will be posted on our website in approximately 2 weeks or so, and then you'll hear from Peggy on the CPE in 6 to 8 weeks. So with that, we'll go ahead and end the presentation. Thank you, everybody, and have a great rest of your day.
Thanks, everyone.